Hey there, welcome to Generations Wealth Talk, and I am Todd Watley with my co-host Ian Weinder. Hey man, how are you?
Doing well, you?
I'm good. So today I'm making you talk about this, okay? I know this is a topic he is not a fan of, but it's come up a lot in the office recently. And so go with me on a little story here for just a second, okay? So you're at home and you have a project on your house that you need to work on, and it's like, I need a tool for this project. So you go down to the tool store, okay, and it's like Majestic Tools or whatever, and you go in and there's a guy sitting at a desk, and you sit down and it's like, I have a project I need a tool for, and he asks you questions and you explain your project, and he sits there and goes, I think a hammer is going to be best for you. And you're like, okay, he thought about it. He's the tool guy. And so he goes back and he brings out a hammer and says, this is the tool that you need. And you're like, fantastic. I went to the tool guy and he told me this is what I need. And you go home and you do your project. And you're like, well, this works kind of, but I don't know. And so let's go back to the tool store. If you had gotten up and gone with this guy from his desk back to his warehouse, you go back there with him and it's all hammers. The only thing he can sell is a hammer. And so, of course, the tool that you needed was a hammer. All right? What people don't understand is that very exact thing happens when they go to financial people. Okay?
Oh boy.
Okay.
I see where you're going here.
So you go into, so-and-so financial and you tell them, I have this money and I want to do this and this. And they're like, I think an annuity is the best thing for you. And you're like, okay, well, I talked to this person and told them everything and they thought about it and they said an annuity is what I needed. Little did you know that the only thing they could sell you was an annuity. All right?
Oh boy.
I know, the A word. You don't like it, but it is a legitimate tool. And what I am seeing is there are a lot of our clients who bought an annuity 2015 through 2020, 22 even. And the market then was very different than is right now.
That's
and
true.
I think you have said this could possibly be a generational event with interest rates and the economy as it is right now is very favorable to annuities. Now, we can sell all kinds of things, but I just want to talk about how some people have old annuities and how sometimes some new annuities may be the right product.
Oh boy.
Okay.
Well, Todd, I love that you're
talk
making me talk about this.
Okay.
And so the one thing that I do want to say before we really dig into this is we're not giving any specific tax, legal, or investment advice. You need to hire a professional. Now, I will say, I'm a certified financial planner, which means that I have a much broader scope than most advisors. I have expertise in, income planning, tax planning, retirement planning, estate planning, charitable planning, and we have to bring all of these pieces together. Planning has to lead to, what product we look at. But a lot of the time when we talk to someone, it's the opposite.
Sure.
They start with product, and then we hope it all comes together. And usually,
it fit the plan.
Make it fit the plan. Or usually, your plan is a bunch of pieces that you don't know how they work together, and so that's frustrating to us. But I really do appreciate that you wanted to talk about this because it's something that I think more education makes a ton of sense for folks, and I want to try to thread this needle a little bit. And so, we are in an interesting time in markets and with interest rates. And so let's talk about how these products work. I think that's kind of my goal today is let's do some education. Let's talk about how they work and then, where they might fit in someone's plan. Okay. And if that's not where it fits in your plan, maybe we should talk about it and figure out if we can trade it in or get rid of it.
Well, and if you're thinking, well, I have an annuity. Okay, well, annuities are like cars. There's monster trucks and there's fast cars and there's big cars and there's small cars. There's all kinds of products out there. And I think what's interesting is if you bought an annuity back in 2015, today in 2025, there's some very different products, just like cars.
Yeah,
okay, a 2015 car, as far as bells and whistles and connectivity and Wi-Fi, you know, that was not available back in 2015. Well, now in 2025, the companies listen to people and say, oh, you want that? Well, I think we can do that. And so a 10-year-old annuity is going to look very different than a 2025 annuity.
It's true.
And like you mentioned with cars, there's some huge dealer incentives going on right now to get you out of those old annuities into some new
Even if
ones.
you're underwater, kind of thing, right?
Yeah,
I like the car analogy. That's easy to understand.
Yeah.
I appreciate that you make these things easy.
I'm very simple.
For me, you know, because I can get lost in the weeds, because I do. This stuff is important, it's technical, and we need to understand it.
Yeah.
So I think what's fun to start talking about annuities is these are not new. Annuities are not new products. The first annuities were around during the Roman Empire.
Yeah.
The Roman Republic,
That's
really.
cool.
You know, when a soldier would go and fight, a legionary, they would go and fight, and when they would come back, you know, if they made it or if they didn't make it, their family would get paid an annunum. Every year, every annum, they would get paid a salary. Now, what's fun about that word too is salary. It comes from salt. They were actually paid in salt in a lot of cases, because salt was a very, very valuable commodity. And so we have these interesting words that we've carried through: salary, annuity, that were from the old Latin, which is kind of cool. So when you say, hey, is this person worth their salt? There's a very technical, literal piece about that. Anyway, I don't want to get too far into the Roman Republic, but they've been around a long time. And this idea of, you know, periodic or consistent income coming in was a way that people lived, and, you know, this is the closest thing that they sort of had to retirement, right? Now, fast forward a couple thousand years to today, we've got all different types of these. And so generally, I think the easiest way to think about annuities is there are some that are designed for income, and there are some that have become designed for accumulation or for growing money, okay? And so of those, there's different subsets. And we can't talk about every single one of these today, but let's just talk about some general ones, okay? And there are, just like vehicles, there are some that we like, and there are some that we really don't like. You know, and so we want to have the right tools for the right job. But again, we have to start with figuring out what is the job that we're trying to do. We have to start with planning. What are we trying to accomplish? Why would we use a hammer versus a screwdriver? You know, if you're using a hammer to put together a fence, it's going to work for a little bit, but it'd be a lot better if we use screws, you know, because things are going to change. And so the main types, income and accumulation or growth, is what you'll hear. But there are different subsets. And so you might see a lot of stuff on the media. Ken Fisher is a big one that talks about this. Ken Fisher is the famous I hate annuities guy, which is really interesting. It's funny because he actually owns an insurance company, and so that cracks me up. You know, at a certain point you go, okay, we got to, what's media here and what's real life. But a lot of the criticisms of annuities are that the fees are really high, or that the performance is really poor. And there are cases where that's absolutely true, but one does not mean all. Just like a vehicle, you know, you might have a sedan and you go, well, that thing doesn't haul very well. Well, yeah, that's not its job. You know, and so we don't want to overly apply these sort of rules of thumb. We want to understand very specific things. And so the type that we tend to avoid in general, unless you have $30–40 million, and then we can look at it, is what's called a variable annuity. And there's really no reason to use variable annuities, in my opinion, right? Unless you want to really overpay for expensive mutual funds. Now, we see these a lot from big banks or from big brokerage houses. The fees in these products will be 2, 3, 4% a year, but they're hidden and they're layered. And this really frustrates me. You know, everyone's got their guy, they love their guy, they're super nice, and they're charging them 3.5%, 4% a year for something that we don't even need. So these are the situations where those products, in my opinion, are poorly placed. They're not placed in the right use, and we don't need them at all. Now, there's another kind that we tend to like a little bit, and those are the indexed type. And so the challenge with the variable annuity is what's variable is what the money is actually invested in. It's invested in the market. And typically people that, if we're looking at an annuity as a solution, we want we want a volatility buffer.
Sure.
We're trying to have some safety here. And so, one, if we can save on fees, that makes sense. But two, why would we try to have some safety and then not do that? It doesn't make a ton of sense.
Right.
And so the other type that you'll see a lot, and there's a good version and bad version of these as well, are called indexed annuities. Okay, you've probably heard a ton of stuff about these. And just like vehicles, there's some that make sense, and there's some that are unnecessarily expensive and don't fit what most people need in their life. The thing that's interesting about indexed annuities is that they track the performance of a market index, and an index is just a basket of stocks and bonds.
Sure.
But they're based on options. And so what's nice is if that index goes up, we can participate. If it goes down, we would choose not to participate.
Sure.
Which is kind of handy.
That's cool.
And so we give up sometimes we give up some potential upside and some liquidity in order to not have to take any losses.
That's cool.
And so for a portion of someone's portfolio, that can be a great sort of anchor. That can be a place that we can have some protection and take some more risk in the market and kind of balance those things out. They're pretty cool, and they're relatively new as far as annuities go. They've been around really about 20 years.
Okay.
And so 20 years
That's
on
new.
2,000 years,
That's new. Yeah.
these are new,
Yeah.
and they're getting better and better. And so there's different types, and they have different applications. But we don't want to make assumptions that just because we are looking for a hammer, that this is the right hammer.
Sure.
To your point. And so
Yeah.
we
That's
gotta talk
interesting.
about
So
that.
if someone is interested, like in oil and gas or technology or real estate or whatever, can you get an annuity that is based on that index?
You can.
Okay.
There's lots and lots of different indexes.
Okay.
And there are some that perform well and some that perform poorly too. And so there's a lot of different pieces that we have to look at. Think of an index as just a portfolio.
Yeah.
And so we want to know what the underlying portfolio is, and that kind of bases our assumptions. But the kind that are interesting right now, to me at least, and when we talk about this is possibly kind of a generational buying opportunity for
Sure.
these, and truly you had to pull this out of me, I didn't want to talk about this today, is these index products are based on the interest rates that are happening right now. And so if you're paying attention to this, you might notice that CD rates have been higher the last few years.
Yeah.
This is what we begin to look at, right? And that's based on what the prevailing interest rates are in the market. But you also might notice that when you drive past the bank, they're advertising 3.5%, 4%, whatever it is, CDs, but the timeline is shorter.
Yeah.
Have you begun to notice that?
An 18-month pays less than a 6 months, which typically doesn't make sense.
We're in an interesting time with
Yeah.
interest rates, and without getting too technical with it, the way that banks raise money is by issuing CDs. Okay, and so what they expect to do, let's say they're issuing a CD at 4%, what they expect to do is turn around and lend at 9%. They make money on what's called the spread, the difference between what they have to borrow at and what they can lend to someone else at, right?
Sure.
Makes sense, and you've noticed mortgage rates and vehicle rates have gone up in the past couple of years, right? Makes sense. But they are forward-looking with rates.
Yeah.
And so the reason that the timeline that CDs are offered these higher rates is getting shorter, it used to be 2 years, 3 years, 5 years, now it's like 12 months, 13 months, 11 months, is because the market expects, the banks expect that interest rates are going down.
Okay. Yeah.
And why? Well, if they can borrow money from you, the consumer, at a lower rate in the future, in the next in 14 months, why would they not do that?
Sure.
And so that's why the timeline is getting shorter.
Okay.
Now,
Hold that thought
Okay.
just for 1 second. So we're going to take a break for just a second. I want you to finish that thought, but then also if someone has an annuity, they're like, well, it's going to cost me money to get out of it. I want you to address that. So please give us a call, 479-601-4119, 479-601-4119. That is our office. Both of us are there. Generations Legal Group and Generations Wealth Partners are there, and we will see you after the break. I know. Okay. Okay, so. Hey there, welcome back. So we were just talking about annuities, and Ian was on a little rant about.
Sorry.
Yeah, that's okay. a lot of good information. So finish that thought, but then I'm sure there are people out there thinking, well, if I have this annuity, I bought it, it seemed okay back then, but now it's going to cost me 3%, 5%, sometimes 10% to get out of it, and I don't want to do that. So let's talk
These
about
can be some of the downsides of these, and very transparently, what we find is that the people that typically sell these, they don't explain all those details, and then you never talk to them again. And so this becomes a problem, and what we find is that we tend to serve those clients and help them to manage those over time. Yeah. And so I want to go back briefly just to how banks and CDs work and then translate to why that's important right now.
Yeah.
And so, just quickly, the way that banks raise money is they issue CDs. You buy a CD, they give you 4%. Well, they turn around and they lend that money back, sometimes to you, at a higher rate. That's how they make money. But you've noticed that in the interest rate environment that we're in, the timeline that those higher rate CDs are offered for is getting shorter. It's because interest rates are going to come down, we expect. The market expects this. Now, insurance companies, this is who issues annuities, insurance companies, they operate differently than banks. They invest for a really, really long time horizon. 100 years is kind of how they think about it.
Okay.
And so they do things differently. They issue these products. This is how they raise money, is they issue these annuity contracts. But instead of being forward-looking with rates, they lock them in. And this is what's interesting. And so the products are built around whatever the interest rate environment is at the time that they're issued. And so right now, we're in a period where interest rates are higher. And so what they do, the insurance company, they buy bonds is really what they do.
Sure.
But they buy them in $100 million blocks. And for most of our clients, they're not buying bonds in $100 million blocks, right? And so, they can get a better deal. They get a wholesale discount on it. That's where the insurance company makes money. They can hold those bonds for their duration. And so they go to the issuer and they say, hey, we're going to buy $100 million this week. We'd like a discount. Since you're not going to have any cost to sell it, we'd like a discount, and they pass that on to the consumer, okay?
Which means higher interest rates.
Which means higher interest rates.
Right.
And so right now, this is why we're in a unique time, is because even products that were issued just a few years ago, they were based on lower, we were near zero for a long time, for a long, long time. And so what the products are built around that snapshot in time. Well, now we're at much higher, and the market is doing well, and so what's happening is it's kind of like like you said, a dealer incentive with a vehicle. The dealers have a bunch of money that they want to give away, and so the products are more attractive, and their ability to buy out these old contracts is a lot better right now. I'm kind of looking at this as, if anyone that's watching this was around in the late 80s and you got lucky and bought 30-year non-callable bonds in the late 80s and you got a 12% coupon on it for 30 years, that was a great move.
You don't sell those.
Yeah, those aren't around anymore. And look, if we had a crystal ball, this would be easier.
Sure.
But I think we're going to look back in 10 or 15 years and go, boy, that was a great time to lock in those products. And so the way that sometimes these products work is they'll have a surrender charge on them. Because the insurance company, when they're buying those bonds, they're expecting to hold that for a period of time, typically 10 years, right? And so, look, they're the big guy in the room, and so they're saying, hey, if we have to take a loss on these, we're passing that on to you.
Sure.
And it's just the way that these contracts work, right? Now, on the other hand, because of the interest rate environment, these insurance companies know that. They want to issue as many of these as they can, and so they're offering incentives to get out of old contracts. So sometimes there might be a 10, 15, 20% cash bonus to get into a new one. And so what we're finding is people who, they haven't talked to their agent, it's not been a great product, all of these things, we can either help them get out of it or we can upgrade it. If it makes sense in the plan, we can upgrade it and sometimes even make money for doing that, which is kind of cool. Yeah,
you're going to pay 2, 3, 4%, but if you get 20%, I mean,
we take that deal.
That's real money. I mean, that's $500,000. That means you're getting a $100,000 bonus on that. That's real money.
That's significant, And so I want to be really careful when we talk about this. Not all of these are for every single situation, and not every dollar needs to go into this, right? And so when we think about where do these fit in someone's plan, because this is the piece that I want to try to bring back together, the way that we should approach volatility, the fluctuations in the market, we don't want to pretend that that's not real, and we don't want to have some exposure to that, because the volatility, the changing in price, is how we make money. You know, your house, there's price volatility with it.
Sure.
You may not watch it as much as a stock, because it may not change as much as a stock.
Sure.
But what you want is for that to appreciate. In a technical sense, that's volatility. So volatility is not bad, but typically the way that traditional advisors will deal with volatility is with bonds. Okay, and so now there's a lot of challenges with bonds, and one of those is the credit risk or reinvestment risk of these bonds. Okay, so stocks, the thing that we know about stocks is that they're unpredictable in the short term.
Sure.
Bonds are the opposite. They're very predictable. It's pretty much a science. We know what's going to happen with bonds. Well, if interest rates go up, bonds that were paying less, their value is going to go down. Why? Because we'd like to buy at a higher interest rate. It's like a seesaw. It's very predictable. And so what we've seen in the last couple of years is that folks that have a big bond portfolio, they were just as volatile as stocks, particularly during 21 and 22.
Yeah.
And so this idea that we want to use bonds to be the safe portion of our portfolio, it doesn't actually bear out in practice.
True. True.
And so when we think about, okay, if we want to have a safe portion of our portfolio, how do we want to do that? Well, the insurance company is going to buy bonds. And so what we're doing when we buy an annuity, in my opinion, when we use it right, when we use the product in the right place in a plan, we're using it as a bond replacement. We're transferring the risk of those bonds, the duration risk, the credit risk, the reinvestment risk, to the insurance company. And that gives us a little bit more stability in the portfolio.
Yeah.
That's where they should be used. And sometimes for income, right?
Yeah.
And so it's a little bit counterintuitive, and we got to get past the oh boy, Susie Orman told me to hate these, right?
Yeah.
It's like, great, I appreciate that. And there's a lot of them that you should hate. There's a lot of them that I hate that we hate.
Sure.
But there's other places where they can fit. And so if you have one that you were sold, you don't understand, no one talks to you about it, it might be time to either get out of it or upgrade it. And maybe that's something we should talk about.
So how do people do that? If they're thinking that, what do they do?
So you can call the office. We'll take a look at it. We'll do some analysis on it. Typically, these products have an annual statement, and so we'd want to see the latest annual statement. We work with tons and tons of insurance companies. Literally any good product that's out there, we have access to them, or we know what they are. There's some cases where folks will bring a product in, and I go, "Look, you want to keep this? This is phenomenal.
This is great."
And then here's some tweaks that we would make. Inside the product, and that's fine. But I think the big thing is, we want to do planning so that we can figure out where that fits and doesn't make sense to keep.
Yeah.
And so we're happy to have that conversation.
Yeah, and again, this is one tool.
Yes.
Okay, we're like Home Depot. You walk in and there's a whole array of tools out there that you truly do need. You don't want to try to saw a 2x4 with a hammer, okay? You need
could
a saw
probably
to
do it, but
yeah, you could do it, but it's not pretty.
It's not gonna work.
And so, that's why after so many years, I got my license, was just because I saw so many people were in products that just did not make sense.
Well, and trying to communicate with the advisor, and the advisor is not going to admit that.
Right.
They're not going to admit that the product didn't work out the way they thought. They don't. And look, I get it. I mean, I think we're a little more transparent than a lot of the folks that we visit. But these are kind of tough conversations.
They are.
And so I think the goal is we want to lead with education. We want you to understand how they work, and not all of our clients use these tools, and that's okay.
Yeah.
But if folks come to us and they have them, we're going to make them work the best they can. We're almost like the mechanic in this if it's a vehicle situation.
Sure.
You don't always go back to the dealer to get service, because sometimes that doesn't work as well. But there are times where trading it in and getting out of the the bad loan that you got makes a ton of sense. And so I think we want to educate, and we want to know what our options are. And the worst case we find out is we don't need to exercise any of the options, and we're doing great. But what we're finding is there's a lot of opportunity for folks right now.
Yeah, and just options, different bells and whistles on these are super cool.
Well, I think we should talk about the nursing home stuff, because this is a big issue.
Yeah, go ahead.
Well, so on a lot of these, when we are working together with someone, particularly what we're thinking about is how do we pay for the nursing home if this were to be an issue? And remember, we talked about these products sometimes have a surrender charge.
Yeah.
Now, there are some that are good products, some that aren't good products. What we're finding is a lot of these older ones don't have the ability to get out for nursing home, if you need a nursing home care. These newer ones have a rider on it, you don't pay anything for it, that if you were to go into a nursing home, no surrender charges, we get the cash back, then we can do our planning.
Yeah.
That's huge. I mean, we've replaced more than one recently for that reason alone, and it's going to be better for the client.
Yeah, so many times I see people come in, they're like, the nursing home wants $10,000 a month, and it's like, I can get that paid for. If you're married, I can protect almost everything if we can get assets moved to the other spouse. And sometimes being in the product that they're in, we have to move that. And so I call the advisor and say, hey, we need to cash this in. They're like, oh, well, that's not a good idea because they're going to lose 10% of the money. I'm like, I know, but they're paying $10,000 a month.
Yeah.
We need this money because I can stop that bleeding. Your annuity pays $850 per month. We need $10,000. Okay. These numbers are not working out, doing nothing. And so, yes, cash it in. Yes, there's a 10% penalty, but we have to do that. It just makes sense because, you know, if that is a $30,000, $40,000, $50,000 penalty, well, I'm going to make that up in 5 months in a nursing home. And so us working together, I'm the elder law attorney, and I'm like, here's the things we need to think about. You're the financial guy to say, okay, this product will do a lot of what you want to do, you know, as a financial planner, but it does what I want to do as the attorney to say, if you need nursing home care 3 years from now, we're going to be able to get this money and not pay the big, huge penalty.
We can avoid those future landmines because we work together and we understand the longer picture here.
It's a fun meeting because I've tried to do this over my career with financial advisors, and it just doesn't work. I mean, I can't get them to talk. They think I'm meddling in their business. You know, it's like, stay in your lane. I'm like, my lane involves your lane, okay? We are now merging together because as an attorney and trying to make sure this person is going to get their nursing home paid for, we have to look at financial stuff. And being able to sit at the same table and look at this whole situation legally, financially.
Bring the tax component into it.
Taxes, oh my God, yeah. And so we bring everything together in one meeting, and it's just a really fun meeting. And sometimes we get a little, now what, stop, you know. He's like, no, Todd, but, you know, sometimes we get a little animated, but it's in your best interest. It's for the client's interest because I'm like, I'm thinking this way, he's thinking this way, and we are learning every day how each other thinks, and it's becoming a very integrated, beautiful model to say, I feel really good about this, and you say, I feel really good about this, and the client says, well, shoot, if both of y'all feel good about it, I feel good about it.
Well, I think what's important too, as we begin to sort of close this out, is, you know, not every person needs these kind of tools in their portfolio.
Sure.
But we act as a fiduciary, meaning we're always going to work in the best interest of the client. And so if we're not exploring all of the tools to be able to solve, you know, and fill the goals that people have, how can we say that we're acting in your best interest?
Yeah.
You know, so we have access to everything. What we decide to use is going to vary based on your goals. But if we don't explore it and educate you, how can we say that we're fiduciaries?
Yeah.
So this is why we need to have this conversation.
Yeah. Just go to a person who can sell you all the tools, not just a hammer. And that's what we do at Generations Wealth Group is we sit down with you and we can do this. So thank you for joining us today. Thanks, Ian. Good show. Please call us 479-601-4119, and we would be honored to work with you. Thanks.